Well, good morning, everybody. Well, good evening. I noticed we have a lot of folks from different time zones. Love having you all here. Now, we're gonna be talking about futures today, but I don't want to be classified as, well, he only talks about futures, because the methodology and the approach that we use when we're looking at supply and demand, when we're looking at our trade entries, okay, it works for every product, including cryptos. So there's a lot of things that we will be doing pretty much every Friday. The live stream where everybody is welcome to come in, trade with us, and observe. We do that a YouTube live stream. And after that, like you're seeing today, we're going to have a bunch of different classes, various different topics. There's a schedule out on our website. So if you go out to the calendar, you can see the schedule and see what topics are coming up if you want to attend. Now, these are little short takes, okay? So it's not a really in-depth drill down. We have the expanded class, which is usually a couple of days long or several hours long. It comes in a couple of different parts. So we'll show you how to find all that information a little bit later. Okay. Our formality here, the information contained in this presentation should not be construed as a recommendation or an offer to buy or sell any security or financial instrument. Additionally, information contained in this presentation does not imply the suitability of any investment strategy. We are not licensed brokers or investment advisors. All attendees of this presentation and purchasers of our content are encouraged to speak with a licensed representative of their choice regarding the appropriateness of investing, trading of any investment, and any trading strategy. We are using real-time market data and will execute trades in a simulated account during our presentations. No offer on our part with respect to the sale or purchase of any security is intended or implied, and nothing contained in this presentation should be construed as a recommendation to take a position in the market. The intent of this information is for instructional and educational purposes only. Any fair use of third-party trademarks or logos does not imply an affiliation or a sponsorship. All trading involves high risk. We make no promises. Let's see. All trading involves high risk, and past performance is not indicative of future results. We make no promises, guarantees, warranties, suggesting that any information shared will result in a profit and not in a loss. You agree to not hold us legally and financially responsible for any reason. All right, so the purpose of this course, this mini course, kind of a crash little course that we're doing right now, is to give you a strong foundation of futures trading. Okay, we'll start off with just some futures products, kind of reminding you of some of the language, lingo that we use. We'll talk a little bit about the fundamentals of futures. What is a futures contract? Why we like trading futures? And understanding the futures contracts, the months, the codes, point and tick value, and margin requirements, and more. And then how to trade futures with smaller capital, okay? All right, but before I jump into some of the fundamentals of futures and why we trade futures, the markets are live right now, so I'm in a couple of trades. I do have, let's see, we're still in gold, and the Dow trade that we took in the live trading room is still underway. Towards the end of this little section, this class that we're doing today, we'll show you how to identify the areas for potential turning points ahead of time. And we're using that picture on the price chart to identify, like here we have resistance and we have a buy territory. Okay. And we have a zone that was within the buy territory. And location of our zones is extremely important. Okay. So I also want to help you understand that there are a couple of different opportunities when we go to place a trade. Okay. is the first opportunity is when you have the information on the left-hand side of the chart, you can take a breakout. Now, if you're referring to supply and demand type trading, you must have a breakout before you have a demand zone. Okay. You must have a breakout to the downside before your supply zone becomes active. So this might be a little new to you. It should be pretty exciting to help you pick trades better. Okay. And using the information, the picture on the price chart, regardless of the product that you trade, because we can do the same analysis on FX markets. We can do the same analysis on stocks. And I think Matt's in with us today. So he does some really good charting on the stocks. Okay. And he posts those in our Discord room. Okay. All right. So the trade I do have set up that we took a small breakout trade on the Russell earlier, made a few bucks. And I'm looking for the next breakout trade at 22.84, 22.84. Oh, I got it at 85.60. Let's just do, yeah, I'm going to leave it right there. So the actual entry right there at just as it breaks out. Keep in mind, there's a little speed bump, little obstacle there. And below the speed bump, we do have a nice low volume price movement up. Okay. That means this area is also what we refer to as a pocket of points. Okay. Now, pocket of points are these, like big drops or big rallies that have very light volume in there, almost like a gap. Okay. So if we get to our entry, selling short, 22.85 and change, okay. Then I'm going to expect a kind of a fast move coming down to 22.71. That'll be my first opposing zone and my target for that trade. Okay. Always keep in mind that anytime you are profitable on a trade, you don't have to sit and wait till it gets to the next level. You can take a profit anytime. Okay. Taking profits as you feel good about them helps create the right behavior in trading. Okay. We're here to have fun in trading, not get stressed out and be all worried about things. Okay. So it's okay to take a profit anytime. So, all right. So let's just get started on some of the fundamentals of futures and why we trade futures. So what are futures? Well, futures are basically just a contractual agreement. It's a standardized contract for the purchase and sale of an underlying asset at a fixed price for a future delivery. Okay. So basically, we're buying the right or selling the right to make a transaction in the future. I do want to make reference that the futures are not predictive. Okay. They're telling us what's going to happen in the future. Futures are a derivative instrument and they follow the cash market. They don't lead it. And that's one of the reasons I do like trading futures. It's because you got the stocks that move first and the equity indexes. Okay. Stocks move first, exchange traded fund follows that. And then the futures adjust their price up and down because it's just a computer that adjusts the future price up and down based on the stocks and the exchange traded funds trading activity. Okay. There are basically 5 groups of futures that we follow. We got equity indexes, we have interest rates, energies and metals, currencies, agricultures, and softs. And within this group, we have it gets divided into a couple of other groups, which are financial products versus commodities. Okay, so currencies, equity indexes, interest rates are more the financial products, whereas energies and metals, agricultures and softs, okay, would be our commodities there. Okay. Now, the difference between the two is that the financial related futures products, their contract expires every quarter, whereas the commodity related, they tend to roll out or expire every month. Okay. And that's good to know because there's some specific trading strategies around crude oil, natural gas, heating oil, gold, silver, copper, especially when they're closing down the front month contract and rolling to the back month. There's two times we have um, the contract rollover, and we have contract rollover, and then we have last trade date. Okay. What did we get filled on? Russell? All right, so come back in. We got filled on Russell. I'm gonna come back in, place my protective stop at 22.89. And I'm gonna come up just a little bit higher. I'm gonna make it a right there. We got 5 micro contracts on this right now. And what I just placed was my protective stop loss. Okay. And you can see right there, if I get stopped out, I will lose 99 bucks. Okay. Now, if 99 bucks is outside of your risk, then size the position. Go with 1 micro, go with 2. Okay. Whatever fits your personal trading plan. Okay. Every trade that we get into, you must understand there is risk. If you accept the risk, then you also accept the potential reward. You know, everybody always likes to focus on the reward, not a bad thing, but we do have to expose the risk so that we're properly sizing our position correctly based on your trading plan. Okay. We'll come back and check on that in a little bit. Hopefully it's not too distracting, but if you have questions, type them in the chat. Let us know. Okay. All right. So when we make a trade, trading futures, our order gets processed and goes through the clearinghouse. So we have a futures trader, whether they're selling a product or whether they're buying a product. Okay. We transact that through the clearing. Okay. When we open or close that, all trades go through the clearinghouse. The computer that adjusts the price up or down, giving the futures price, is what's called the Globex. Now, I know a lot of times we understand the Globex as the overnight, extended hours trading, but the Globex is really an acronym for the computer that processes the orders. Okay. So why trade futures? A lot of reasons. Okay. You got a lot of leverage and you can make some small moves in price to crack the daily nut. Okay. You got daily trading up to 6 days a week, 23 hours a day. Okay. Diversification. We have many different products we can participate and trade with. Okay. As you saw with the 5 different groups of futures, we could be doing financial products, we could be doing commodities, and so on. Futures are highly liquid, easy to get in, get out, and very often the spread is much smaller. As far as the taxation, US based, there's still the 60-40 tax rule, 60% tax at the long-term capital gains rate, and the other percent at a lower rate. Okay. So you have so you're not getting taxed very high on the short-term in and out type trades. The other thing nice about trading futures, I could trade with a relatively small account. There's no pattern day trading rules. I don't have to have a minimum account size of 25,000. I just have to have the enough capital to cover the initial margin to get into the trade. Now, when trading futures, we generally speculate on the direction, the price of the underlying. Okay. Most of us are not set up to take delivery, but we do need to understand that when we have deliverable products, like our commodities, a large amount of our commodities are deliverable, while some of our financial products, like the FX markets and bonds and notes, they are deliverable as well, but our equity indexes are non-deliverable. Okay. Now, why does that make a difference? To know if your futures contract is deliverable or non-deliverable, you can use a reference of the CME group to see the contract specifications. Okay. But there are different times when we have our commodities, when we do contract rollover, we often see the price goes lower around contract rollover, then it bounces back up, okay, around the time frame in between, and then price often goes even lower right before the last trade date. We'll talk about some of that terminology going forward, but the last trade date has been proven to be a pretty exciting time trading the commodities, and it's a very specific date every month. All you do is look at the information in front of it. You see the price is going down, find your demand zone, or wait for a new accumulation of orders. And then anticipate that if everybody getting out at a back month contract, or sorry, the front month contract, that they don't want to take delivery, then they will be buying the back month. Okay. So when we are trading futures, we have the ability to go long, we have the ability to trade to the downside. Okay. So if we sell it, okay, price going up, we'll look for the loss. If we sell it and price goes down, we're going to profit from that. If we go long and we buy the futures product, we're looking for profit to the upside. And if price goes lower, then we have our stop loss, or we're going to take a loss on the trade. Okay. So different ways we can buy low and sell high. We can buy high and sell higher, like on breakout trades. We can sell high and then buy it back lower, or we can sell low and buy back. So we have trending trades, and we also have the beginning of a trend trade. Okay. How are we doing on questions? Doing okay? So how do we do this? Well, we identify high probability opportunities using technical analysis. And what you're going to learn here is what is our leg base group of candles. Okay. We take advantage of the order imbalances where there are leftover unfilled orders. Now, what we have noticed is any place we look to desire a trade, whether we're looking to go long or looking to go short, as we look at a price chart, looking over to the left, we can find a very specific group of candles, which is called the leg base. And we'll talk about that a little bit more as we get further into this. I'll show you the pictures so you can verify and check the information as well. So when we have a desired long trade or a desired short trade, we need to look over to the left. We not only need to look over to the left for the leg base group of candles, but additional information that might be there to help support whether we should be going long or short in that range. Okay. Now, price only changes direction when we have more buy tickets over sell tickets, or where we have more sell tickets over buy tickets. So as much as we like to bring the drama into trading, the only reason price changes direction is because of the stack of orders there. Okay. Now, how do we anticipate that there's a large stack or a small stack of orders there? We use the information on the left-hand side of the chart, which we will demonstrate. Okay. So a couple of pictures here as we're looking at it. Okay. We use chart patterns to help us anticipate where projected moves. Okay. Structures and patterns. These are a couple of examples of, us taking the breakout trade. These are all done in our live trading room. This is where you folks will come and kind of watch what we do, follow along with us. Okay. I don't encourage you to start trading right away. Take the time and learn from us, test us out, verify the information we're sharing with you before you risk your own capital. Okay. Now, your broker may set a minimum requirement to establish a trading account. For example, a company like Tradeovate, a broker, okay, requires that you have $2,000 US to open an account. Okay, a broker is a choice and it's a personal reference. We don't recommend any brokers. Okay, not that they're bad. It's just that there is certain liability if we uh, recommend a broker. Okay. Now, depending on the futures product, you may be able to trade for as little as a few $100s. I think Tradeovate, if you want to trade the micros, it's like $50 a contract now. So the margin rates are really, really cheap. Okay. And then they're different with each product, whether you're trading micros, minis, or a standard lot. Okay. One of our affiliates that we're working with. So if you don't want to risk your capital while you're learning how to trade, you can come into one of our, and we do have a reference code that you can use on this, a promo code. And these are called proprietary trading firms, okay? Prop accounts for short, okay? So with a prop account, proprietary trading firms, and I encourage you to look it up to see what they do, are the companies that provide capital to skilled traders. Instead of trading your own money, you can trade their funds. How good is that? Okay. Now, I do believe that this is available to the Singaporeans. Indonesia has got some different regulations around that. We will have to find a workaround. Okay. So think of it as getting access to a significantly larger pool of capital that you might have on your own. Okay. So how does this work? Well, with many of these prop firms, okay, you go through an evaluation. Let's follow the trades that we're doing here in the live trading room. You demonstrate your skills through an evaluation process. Usually it's on the simulator, okay, and different little trading challenges. This shows them that you can manage the risk and generate profits. Once you pass the evaluation with this prop firm, as I mentioned, our example here, the Elite Trader Funding, okay, and you'll see some of the parameters. If you want a $100,000 account, uh, you have a max of a $3,000 trailing drawdown. Once you make $6,000 on that prop account using 100 grand, then you move to the next level. Okay. Now there are some parameters there. It requires that you have a minimum of 5 trading days. Okay. And each prop firm is going to have a little different setup like this. Okay. So once your account is funded, you'll get another simulated account, which you start making money off of that on the money that or on the trades that you make. And then the third level is you get a profit split. You trade the firm's capital, earn a percentage of the profits you generate. This percentage can vary depending on the firm and your performance. Okay. So why use their capital? Well, when we trade our own capital, we have a little more emotions connected to it, right? I know I do. But even trading in a prop firm, you'll see that those emotions are still there, and we still have to work on some skills when it comes to that. Okay. So you have access to capital if you're trading in a prop firm. You trade with significantly more capital than you might otherwise have access to amplify your profits. Risk management, a prop firm will then provide training and resources on risk management to help you become more disciplined. And with the Elite Trader Funding, we are um, partners, so that we can we put our we put a lot of information out there with them. Okay. You have a professional environment. Many prop firms offer professional trading environment. A lot of those old floor traders and big traders that are on the floor, they have infinite amount of wisdom. and you can hang out with them and watch what they're doing as well. Okay. Now, some people never want to risk their own capital, and you can open up multiple accounts under one of those prop firms. Okay. There's a posted link with a promo code that the team just posted in there. Okay. And I also have this if you want to scan the barcode, you can get in there and get access to the information to see if that's something that you would like to do. Okay. All right. So let's jump right into what is a futures contract. We'll talk about months. Okay. Understand a few contract months. Each futures contract has a specific contract month that it can be traded. Each contract has a first trade date and a last trade date for future delivery of an underlying asset. We want to trade contracts with the month with the nearest expiration date, which we relate to as a front month contract. Okay. So a little bit of vocabulary there. Any contract after the front month should be considered and called a back month contract. Okay. We also want to verify the contract retrading has the highest volume and open interest. Okay. So we can, let's see, it's come out here. When you go out to the cmegroup.com, you can scroll down and see all the various different futures products that trade on this exchange. You can look, let's just take crude oil futures since we're looking at contract rollover yesterday. Okay. And as we bring up, we can look at the volume and open interest where we can verify which month has the most traded volume. Okay. Now, right now, March is closing down, and you get an idea that they moved 37,000 contracts closed on the March contract, and 17,000 have moved to the April contract. Okay. Anytime you see the volume of the front month compared to the back month, when the volume of the back month exceeds more than 50% of the front month contract, that's when to start looking at that contract rollover. Okay. Now on the same page, you can come up and see there's a lot of different things at contract specs where we can learn about where this contract trades. What you are controlling with this is 1,000 barrels of oil. Okay. It trades in US dollars. I mean, you have to convert US dollars to buy or sell this futures contract. We got the trading hours. What increment, every penny it moves, we get $10 per tick. It trades on multiple exchange. We got the CME and the Globex exchange is one we trade on. You have the Clearport, you have clearing, you have TOS, and you have TAM. These are just extra exchanges where where bigger traders can trade on. Okay. For us, what we're doing, we trade on the CME and use the Globex. Okay. Under the calendar, we can get a good idea of when the first trade date is and when the last trade date is. Now, last trade date very often provides a great trading opportunity for that day. Long running trends, good profit margin on that. Okay. And you watch how price comes into like on the 19th, okay, of February. And then on the 20th, we would anticipate everybody has to buy the new April contract. So we do see price going up. So there's a lot of strategies that we bring in, and using the CME group as a resource, you get very comfortable while you're learning each of the products and how their contract specs and so on are. Okay. So there's the website right there, cmegroup.com. If you need more explanation, let us know. Some more basic terminology here. Contract rollover. Now, contract rollover generally happens a few days before last trade date. And contract rollover is when one futures contract expires and the next contract becomes the new front, the next contract in a cycle becomes the new front month. Excuse me. The near month contract, also known as the front month, which is the current futures contract being traded, usually with the highest volume and with an expiration date at the closest to the current date. A forward contract, also referred to as a back month contract, is the next futures contract in the cycle where the active trading will roll over into. Active trading volume moves from the near month to the forward as one contract expires as the date gets closer. All right, how are we doing now? No, I just needed to take a breather. Got to breathe once in a while. Keep talking too fast. All right, so let's break down what a futures contract looks like. Now, there's three parts of a futures contract when you're looking at the product code, the month code in which the contract expires, and then the expiration year. Okay. So just to keep it simple, usually the first 2 or 3 letters in the sequence. Okay. First 2 or 3 are the product code. So if I'm trading the micro S&P, I put the MES, 3 symbols, or I'd use the mini, which would be the ES. And you also have the large contract on the S&P, which is the SP. Okay. Now there's much like Forex trading, you have a standard lot, you have a mini, and you have a micro. Okay. So you have all the products pretty much are the same, but there's a less capital being used. Okay. The month code, having a good reference to which month you should be trading. Okay. You want to trade the one with the highest volume. You want to trade the one that's closest to the month you're trading at. Okay. Contract expiration refers to the year. 224, 25, 26. Okay. You can buy futures contract way out in the future and utilize that as a hedge. So if you want to hold things overnight, it kind of creates a spread and it reduces the margin rate quite substantially if you're long and short at the same time. Okay. Not going to get into that strategy right now, but there's a lot you can do with futures. Okay. Is that a duplicate? Yep. Okay. So generally in charting a futures contract, you have a contract specific symbol, depending on your chart pattern or charting platform or broker you use. You have a contract specific, and then you have a continuous contract, okay, that connects all the contracts together, either at contract rollover or at expiration, okay. And then you have what we refer to as the .D chart, okay, which only has daily session data on it only. The @YM is a 24-hour chart, and so is the contract specific symbol. Okay. All right. Now, some other basic terminology and how we put things together. Okay. We need to understand what is a tick. Okay. Now, a tick is the minimum price move for a specific product. Some products move in 10-cent increments, some in 25-cent increments. Micro Bitcoin trades in $5 increments. Okay, so that would be a minimum tick. Okay. The tick value is the monetary value that each tick is worth. So if I'm trading crude oil and it moves 1 tick and 1 tick equals $10, okay, so I have one maximum grouping of ticks makes a point. So 10 ticks, $10 a tick is $100 a point. Okay. The point value is the monetary value that the whole point is worth. Okay. So just a basic breakdown of some of the equity indexes. Okay. The mini futures contracts. Okay. E-mini, S&P, NASDAQ, Dow, Russell. Okay. You can see the product code, the letters that we matched up with, the contract months that they trade in every quarter, March, June, September, December. We also have the micros. You can see they have 3 ticker symbols to them. Okay. With the minis, it pays out trades in 25-cent increments, 25 cents a tick. There's 4 ticks per point. So the tick value on the S&P is $12.50. 4 ticks make a point, which are $50 a point. I know a lot of this might be kind of basic for you, but it's a good review. On the micros, it does trade in 25-cent increments. The micros are 1/10 the cost of the minis. Okay. So when we're looking at the micro S&P, still trades in quarter points, 4 ticks make a point, $1.25 per tick, $5 per point payout. Okay. When we look at the 5-year, 10-year, 30-year bonds and notes, they also are a financial product and they trade each quarter, March, June, September, and December. We see the tick value. Okay. When we have 1/64th, there's 128 ticks per point. Okay. 10-year trades in 1/32. Okay. So there's 64 ticks per point. The 30-year trades in 30 seconds. We can see the tick value, how many ticks, and what the point value is. Okay. When we look at crude oil, micro crude, nat gas, micro natural gas, okay, we're looking at all contract months. So this must be a commodity, and gold, micro gold, silver, copper, and we also have mini silver, mini copper. Okay. So there are more products in here that as you break them down, but the commodities expire every month. Okay. It's important to know the tick value, how many points you're looking at, or how many ticks per point, and what that pays out. Okay. You can use this as a reference, but I encourage you to go out to the CME group to get a little bit more on that. All right, another financial product, which we have our currencies, Aussie dollar, Canadian dollar, British pound, Swiss franc, yen, euro, and there are a few other ones, but these ones tend to have the more volume around them, easy to get in, easy to get out. Depending on the broker that you're using, you may have the old pit symbols like EC, and then you have the exchange symbols. So that's why we have different product codes on there, because the brokers do vary. Okay. What their tick increments are, how much they pay, how many ticks per point, and what the full point value is. Okay. Our agricultures and softs. Okay. Corn, wheat, soybean meal, bean oil. Now, these products are a little more safe to trade when you don't have any great setups on the equity indexes. Being able to just read the price chart, see the picture on the price chart to where you can manage risk and look for potential reward and entry as well. Entry, stop, and target. Okay. If we focus on the picture on the price chart, you can be diversified when the equity indexes are not doing anything that day, or maybe too volatile to trade in it. You can look at the other products. You got 5 groups. It's a small group. You got 5 separate groups of futures products. Okay. But if within that you have financial products, you have the commodities, and you might find that other markets are easier to trade when the equity indexes are going crazy, okay? When you go out to the CME group, we kind of already did this a little bit, cmegroup.com, you select a futures product, okay? Let's bring that back up here. You can look at the different markets, and as you do, you can see all the different markets down here, and you can also see the micro suite. Okay, so if you want to see the contract specs, what the minimum price movement and the micro, for the micro, just left click on that, it brings up another page. You can see they got micro crude oil, micro equity indices, micro Bitcoin, micro rates, copper, micro future, FX futures, okay? And as you start scrolling down, let's just start with the equity indexes here for the micros. Okay, then you can click on any of these and get a breakdown, okay, of the different futures product. We were just looking at the micro Russell. Okay, you would click on the contract specs. Contract unit is $5 per point. Okay, or five, yeah. Trades in US dollars. These are the trading times. It's trades in 10-cent increments, and you get 50 cents for every tick. 10 ticks, you would get $5 per point. Okay, you can break it down. It's financially settled, not deliverable. Okay. Then you can look at the margins. Now, the margins off the CME group are the amount of collateral that the exchange requires. Maintenance margin, okay, is what must be maintained in the account the whole time the position is open. $804 per contract. But there are other brokers that have intraday margin requirements. Okay, so we take the same micro Russell, an example using TradeStation as that example. There's a micro Russell. Okay, so with this broker, TradeStation, the initial margin intraday is $221 US per contract. Okay. TradeStation only requires that you put up 25% of that $221. So you're putting up about 50, 60 bucks per contract intraday versus holding it overnight. Okay. All right. And you see how we get use the CME group to come out and find those opportunities. So, okay. Identify the contract month with the highest volume. This is kind of a review. Take a look at the contract specs, understand what you are trading. Now, after you do this a couple of times, you pretty much get it memorized, okay? The contract expiration date is the last day that the contract is valid. It's also called the last trade date, okay? Traders that are using futures as a hedge on a commodity, okay, usually like to wait to the last minute. As a retail side of things, we do have to roll out our futures contract earlier, and depending on the broker, they may not let you trade a futures contract that's within the contract rollover, between the contract rollover and last trade date, unless they have some confidence in you. Okay. Individuals will either take physical delivery of the underlying asset or close their position. So another term there. We got last trade date. Okay. But we also have cash settled. So what does cash settled mean? It just simply means you went long and you closed the position. You bought it, you sold it. You sold it, you bought it. Cash settled. Okay. Taking delivery means you've got to have the other account set up. You've got to come up with the additional funds to take delivery, and then everything will be shipped to you. As traders, we look to speculate on price direction, not take delivery. We will close our position either for a profit or a loss. And generally, if you're using a proprietary trading firm, make sure you understand when you have to close those trades. Okay. Most of the proprietary trading firms, they are mark-to-market accounting, okay, where they will close all open positions, okay, and you need to close them yourself. And if they have to close them, it might be in violation of one of their trading rules, okay? As mentioned, we don't want to take delivery of a futures contract. As an example, we look what would happen if you took delivery of crude. As we already looked at crude oil, you're controlling 1,000 barrels of oil, okay? Huge. I mean, we can put that in your garage. So when we review a futures contract highlights of crude oil on the CME group, we can see a futures delivery of crude oil means we would receive 1,000 barrels of oil. As a trader, we're not looking to take delivery of the underlying product. When we speculate, we're just speculating on small price moves throughout the day. There are three different types of margin. Okay, we have the initial margin set by the exchange. These are the margin requirements that make participant or that the margin requirements that market participants must pay when they initiate a futures long or short position. While the exchange sets the margin amount, the broker may require to collect additional funds for deposit, or they may choose to take less collateral on that trade. Maintenance margin, also set by the exchange, is the level which the market participants must maintain their margins over time. Okay, that means there's an initial trade, that the initial amount of margin that must be there when you open the trade, and then there's a maintenance margin that dollar amount must remain in the account the whole time the position is open, kind of like a collateral. Okay. If the funds of your account drop below this level, you might receive a margin call. Okay. You might be forced to close out your position. Intraday margin is set by the brokers, and it is a wide variety of intraday margin requirement. The minimum balance required to enter one contract during the trading hours. Now, sometimes the trading hours will vary depending on the broker or proprietary prop firm that you're going to use. Okay, so make sure you kind of look into the rules and guidelines of each one of the firms that you're looking at if you're going to do any proprietary trading. I strongly encourage you, if you're still learning futures, get involved in with a prop firm. Okay, don't put your own capital at risk at this point. Learn to refine your trading plan. Okay, it's much smaller risk. If you blow up an account, you can always reset it for a small nominal amount. Okay, some examples. Okay, we got the micro S&P to help you with some of this, the margin amount. We have intraday margin, $151. Now, this may have changed. I don't think we've updated this one just yet, okay? Because we were just looking at it. And the margin, I'm sorry, the margin rates can change based on whether the exchange feels there's more risk in the market, okay? See, if the markets are really volatile, okay, and the exchange feels that they're at risk of somebody defaulting or not being able to provide delivery, okay, they will require more collateral. Okay, just good to know. If you notice and monitor when they increase or decrease the margin rates, you can use that as an additional odds enhancer. Increasing the margin rates don't get upset about it. It's just giving you an alert. Hey, we feel the exchange that there's more risk in the market, therefore we want more collateral. Okay. But that is also an alert that, hey, if the exchange is feeling like there's more risk in the market, how active do I want to participate in here? Okay. So use this as an example. Margin rates increase and decrease. So I don't think we've updated this one just quite yet. Okay. I mean, we're close. But TradeStation, uh, you only have to put up, have in your account in order to trade is 10% of the initial intraday margin. Okay. So 10% of 151 bucks, not bad. Okay. Trade Ovate, another example of a broker, wants $50 per contract. Okay. So you have to choose which broker and kind of look at what their intraday margins versus the overnight margins. Overnight margins will always be what the exchange requires, but the intraday margins will differ between brokers. Okay. When we go to the CME group, you can click on margins, kind of see what that margin rate is. And let's do that one real quick here. So this is on the micro Russell, the exchange, CME group. Okay. CME group requires, and we're looking at the front month, the March contract. Okay. You got the June contract, you got the September, and you got the December, and you can go all the way out 1 year to March of 26. Okay. So there's often multiple contracts on one product trading at the same time. Okay. Now traders can use these multiple products by going long the back month, short the front month, kind of creating a spread. Those would be called an intra-market spread. And then you have inter-market spread, like the S&P to the Russell, or the Russell to the NASDAQ, Russell to the Dow, and so on. What we're looking for is what the outright is and what the CME group or the CME exchange requires, $804 initial or maintenance margin to be in that trade and hold it. Okay. Okay. Now let's get into some fun stuff. And I only got about 20 minutes left here. So I know it's getting late for some of you folks over there. This is where I like to show what we do here at themarketinstitution.com. I'm going to introduce you to the leg base group of candles. In order to find your buying and selling territories, we need to identify the leg base group of candles. Okay. Now I use this specific group of candles to identify a zone. Okay. Some terminology: leg in, base, leg out, base. Okay. We have the initial leg in, we have the base, a leg out, and a base. If we're going long, we want the leg in to be red and the leg out to be green. Going short, leg in must be green, leg out must be red. Okay. The variations to this pattern for going long, leg in must be red. There must be a base candle between the leg in and leg out. Terminology: a leg candle refers to that the body is greater than 50% of the candle's range. The range is from the high point to the low point. When the body, open to close, is bigger than the whole range, greater than 50%, we refer to that as a leg candle. A base candle is where the body is less than 50%. Okay. All right. So again, leg candles, base candles. Okay. Now let's go into the variations of this. In a buying territory, okay, so this must be located in a buy territory. How do we identify a buy territory? Well, we put resistance, and then the area below the resistance is our buy territory. We're looking for that leg base group of candles in that range. The leg in must always be red. The leg out must always be green, and they must be leg candles. Base candles can be any color, and you must have base candles 1 to 5. You can have up to 5 base candles between the leg in and the leg out. The leg out must be green, and they must be leg candles. You can have multiple leg out candles, but no more than 4. Okay. The first base candle after your leg out is what completes the sequence. Okay. Completes the sequence. Leg in, base, leg out, base. Okay. So why do we use that? Well, when I was trying to discover what I wanted to create on the price chart, okay, I started looking at, man, I would have loved to gone long right here. Nice up move. Well, I started looking over to the left to isolate and identify what is consistently there when price changes direction. What group of candles? So I started putting that leg base together and got very specific. So specific that a computer can replicate leg in, base, leg out, base. This range helps me identify my risk on a trade. Now, I want you to appreciate this, that zone was created well in advance before it came back and retested. So what this implies to me is that there is a picture on the price chart where we have some unfilled buy orders in this example, and where we might have some unfilled sell orders when we look at a place where we desire to take a trade short. But our first step in discovering this is taking a picture of the price chart. I'm going to use gold as a reference over here. Okay. We had a trade on gold the other day right here. Okay. I'm going to go back out to my 60-minute chart. Okay. Now, with certain platforms, you can uh, identify the leg base, the leg, you can separate the leg candles from the base candles. And we do this with this particular platform. We put a little blue dot on them. Okay. I'm just going to make that blue dot a little bigger. So every candle that has a blue dot on it is a leg candle. Okay. I'm sorry, a base candle. Okay. Now we want a specific group of candles. We want the leg in, base candles, leg out, and at a base. Concludes the sequence. This is where we put our proximal and distal line around. Very specific. Why? Because that trade you desired right there to go long on gold, okay, right at that point there, the leg base was present, price change direction. Okay. What helped the trade better was that we had a resistance where the sellers were pushing price down. Price hit it once, twice, 3 times, and then broke out. So no more sellers at that level. Okay. We made a higher low prior to the breakout. Therefore, our leg base group of candles, we would be looking in the upper 2/3 of this. Okay. Now, if I go out and look at any chart pattern or any chart, I'm just going to click on one over here. And I'm looking at a 120-minute chart, and this happens to be a stock. Okay. So what I want to find is a place on the price chart where I desired to go long or I desired to go short. Okay. This is the first step. I'm giving you a lot of insight on this. Okay. How many, type in the chat, how many would have loved to gone long right here and taken that that move to the upside. Now, this is just on a stock. It works on everything. Okay. How many would love to have taken a long entry right here and just rode this up? You're going from $260 up to 300. Oh yeah, everybody. Okay. So how would I get into a trade here? Just hit the button? Well, at that point, when price is right there and you're kind of looking at this way, you're going, man, we're in a downtrend. Okay. You might you might wait for indicators and oscillators and so on. Okay. But what I wanted to point out is if I desire to take a trade here, I need to look over to the left. Let's also put the little blue dots on here so we can see it very clearly. Those aren't little, those are kind of big. There we go. So what we can recognize right now is that there's a leg in candle, there's a base, there's a leg out, there's another base. That group of candles, as we isolate them, like that group of candles was present before your desired trade. Does that work on the FX markets? I don't know. Let's look. Aussie dollar, Aussie USD. Okay. Now, this is not bound by a time frame. It's the picture on the price chart. Okay. So when price changes direction, and very often when it changes direction very abruptly like this is a desired trade that we like to have. Okay. But how would I be waiting right here to catch that turn? Well, if there is something over to the left-hand side, like a leg base, we could then interpret that. Okay. So looking over to the left, I don't think we've been this low for quite some time, so I might have to use another example. Oh, there we go. We found it. All right. So let's isolate the area. Okay. And what we're going to look for in that range, again, is the leg base group of candles. Now, most often traders look at pivot lows and pivot highs for that leg base group candle. And it's a good starting point. But if you look closely at the group of candles where there's potential of leftover unfilled orders. Oh, thank you. Okay. Can you see the leg in candle here? It's red, base, leg out, and another base. Okay. So again, we have that group of candles right there, and we isolate that group of candles. Now that was way back in April. That was made. Okay. Now let's come over and see if that matches up with where we desired to enter a trade. I don't know about you, but that can make the hair on the back of your neck stand up. Okay. Kind of gives you chills. Way back in April, they built a leg base group of candles. And when price retested that area, price changed direction. When you first start discovering about the leg base group of candles, you should be driven to disprove it. How could I be looking at charts for 20, 30 years, several years, whatever, and never see that? Here's another desired trade. So let's adjust the time frame and look right in here. We already know the trade worked, and that's what's important about studying the left-hand side of the chart, is you're looking for picture-perfect past trade setups. Now, obviously, I don't see the leg base on a 120-minute chart. Let's go down to a 20-minute. Okay, and then let's look at the desired trade entry, which is right here. And then we'll go back over to the left. Okay, and we're going to look for that leg base group of candles. Okay, now keep in mind, gaps represent a leg candle. If it's a gap down, it's a red leg candle. The gap up, it's a green. Okay, we're down to a 20-minute chart, and I still don't see the picture just yet. Okay, so what happens if we go to a 19-minute chart? Well, in a 19-minute chart, as we described, gapping down, so that would be a red leg candle. Okay, leg in, base, leg out, and a base. As we wrap the proximal and distal line around that, we see that this was here first and price changed direction. Now you could do that by adjusting the time frame, and it's not time frame specific. But what is the evidence on the left-hand side of the chart that helps us project the right-hand side of the chart? Okay. Now, in later classes, in the next couple of weeks, we're going to go into much greater detail on this to help you see these pictures. Today, I'm just exposing it to you. Okay. Leg in, base, leg out, base. This does work without doing large time frame, small time frame, and so on. Okay. But traders often like to use the large time frame as their trend direction. Okay. The large time frame would then tell you that if you have a leg base in a supply zone, you want the trend to be going down for a higher probability of success. Okay. When you're identifying and isolating the candles, you need to get the exact picture. Okay. And I'm expressing this, the exact picture. The colors even matter on this. And the exact picture, you can have a leg in must be green, the leg out must be red for supply. Base candles can be any color. I can have 1 to 5. The very first base candle after the leg out concludes the sequence, and that's where we place our proximal and distal lines around it. Okay. What I want to impress upon you today is that if you want a forward-looking technique to help you anticipate potential price turns ahead of time, you need to start studying the left-hand side of the chart on a chart where you desire to have a trade. So let's do one more example here. We're going to come out, and I know we have a lot of students that trade FX, so I'm just going to randomly pick, let's see, USD, Canadian dollar. Okay. Now, it doesn't matter where I start because I want to find maybe even a couple places you say, you know what? That would be a great short trade. This would be a great short trade. Oh man, look at that move down. This is what we desire. And really use your emotions. What would happen if you went short here and took that whole move? Would that make your month? Would it make your day? How about this one? Would that be a great trade right there? Absolutely. In order to find that and say, have a starting reason why price change direction, look over to the left. Okay. And when I look over to the left, I can see that there's a leg in, base, leg out, and a base. When I get comfortable with this, I place my proximal and distal line around the group of candles. And now I have some validation that this was here before this. This is a trade I desired, so how would I isolate and use that going forward? Okay. Another one. Okay. Where do I get the answer to find out why price changed direction here? We look over to the left. For a supply zone, the leg in must be green and the leg out must be red. In between the leg in and leg out, base candles only. First base candle after the leg out concludes the sequence. Does it matter that I used a 19-minute chart to get a picture of a desired trade? Okay. I don't think it matters to you. What matters is you got your desired trade. Okay. Now, spending a lot of time on the left-hand side of the chart to verify this information. Okay. Then we would move over to the left-hand side. Now, on the left-hand side of the chart, I take current price and I start looking up and left, and I find another group of a leg-base group of candles. Now, I can't rewire myself if I just keep using the hard right side. I'm not learning anything. Okay. What you need to learn when you're looking at a trade that you desire to take is the other parts to where you find that leg-base group of candles in the right area. Yep. Whereas you have support, you have the sell territory, and all leg-base group of candles within a sell territory or a buy territory are where you're going to look to forecast your next turning point or next trade. Okay. We also have to understand what is the difference between a pivot point and what is a zone. Okay. And when a zone can be used twice and when a zone can be used once. That's not going to be covered today. Okay. Your first set is to validate and verify going through any product, any chart, a trade you desire to take, and then look over to the left, adjust your time frame up or down, and verify the leg-base group of candles. Okay. Gets very cool. This is what we use in our trading. We used it today in, let's just double check. We got a NASDAQ. Okay. S&P. Yeah, we used it on the S&P, finding a leg base. Price came back up. We had a sell territory. We took a nice little trade. Now, forecasting, we're saying, well, if and when price comes down to this demand zone within the buy territory, we look for that leg base group of candles there. We're not looking at all these rallies areas because there's not enough evidence to the left-hand side of the chart that says there are unfilled institutional orders there. Okay, I'm going a little long. I love teaching this stuff and trading with you, but we do need to keep a kind of a time limit on that. Okay. All right. So we're getting a little bounce back up. Nothing's been violated. Let's keep going. So we have lots and lots of examples. You may see that we have prep screen zones on here, and then we have regular zone or overnight zones. A prep screen zone is a zone that's formed during the regular trading hours on increasing volume, whether it's to the short side or to the long side. Okay. Has a little different criteria. Okay. Has all the criteria and a little bit more to make it a more higher probability trade entry. Okay. And then we have the smaller zones inside. Okay. This was so nice. I'm glad you got that, Harvey. That was a great screenshot you captured. Okay, you had that leg base. You saw we hit it. Oops. So I thought that was I was going to scroll down and show you the entry. Okay, but that was just a beautiful entry. Leg base was there. Okay. All right. So I trade the micros on a budget. I think we're running a little long. Why don't we save this section? I'll bring trading futures on a budget. We'll bring that in a little bit later. Does that sound okay to y'all? Okay. We'll elaborate on that, and we'll use that next week when we do a little follow-up on this. Okay. Some additional odds enhancers that we use as a pre-market routine. And you see that this morning we did a pre-market routine where we gather information, news, our prep screen zones, economic reports, and then we gather additional information, whether price is trading inside or outside the prior session's range. Okay. all part of our pre-market routine. And as we go through the pre-market routine, we see these little measurements that we take on a day-to-day basis to help us know what is a normal trading day and when things are going to be choppy. This helps us manage expectations, okay? Our internals help us get a barometer of what's going on, okay? Other internals we use, the tick, the trend, the tick, the VIX, and advancing issues over declining issues. They kind of tell us how the market is moving, okay? How to interpret whether it's going to be a flat day or a very active trading session, whether we should be bullish or bearish. A lot of these odds enhancers in here. And we do have a couple of course material, like little one-off classes, okay, where you can get very big detail. This class takes me about 2 days to cover, about 6 or 7 hours of time. So we do have that recorded if you want to get a jump start on that, okay? In the pre-market document, the Globex range for each of the indexes are compared to the daily ATR. This gives us insights on how a regular session will act around session open. We did this on the crude oil and natural gas today too, compared the Globex range to the daily ATR to get a feel whether it's going to be choppy around the open or whether it's going to be more trending market, or to look for the volatile, the bull trap or the bear trap, okay? Globex range compared to the daily ATR, okay? So we have a daily chart, and we have the average true range. And in this example, the average range on the S&P, 35 points. The Globex range was 17 points, so it's kind of right in the middle between that 40 and 70%, okay? Which means we would have more of a choppy session open. And when the session did open, it was really choppy, okay? Really whipsaw, okay? Another short trade example using our prep screen zone. Like these examples. These are some older ones, but we do have some that just happened this week as well. Short to NASDAQ. Okay, price came right up in a prep screen zone. Oh, this was yesterday. Yeah, that turned out to be a pretty good trade too. MES, another prep screen zone. Price was running up there. I had to take this one in the overnight session because by the time that price got up to that prep screen zone, I had to step out of the prop account. I had to close out the trade. Okay, and I got back in an hour later after the regular session started up again. So if you have an interest in using the prop account, if you got some questions, let us know. We'll help support you on that. You can use this barcode. All right, everybody have a wonderful weekend. If you have any questions, comments, or concerns, please let us know. We're happy to be available and help you and support you while you go along your trading journey. Thanks again, team, and everybody. Thanks for coming and hanging out with us. A very nice group of folks. And so glad to see all of you folks from Singapore and Indonesia in the room. Really appreciate you and want to get you back to making profits. Okay. Have a great day, everybody.